long-term enterprise value, which essentially, thank you, dear colleague. Which essentially means that we're trying to understand how to transform the capital that we've raised over the past couple of months. We've been talking about raising capital, managing the risk associated, and now we're going to be talking about how to make sure that the funding that we've accessed, the capital that has been raised, we're able to transform it into long-term value within the business. Thankfully, today we have two very seasoned, intelligent professionals with us today. We have Mrs. Ojuru Adeniji, and we have Dr. Ayodeji Ebo. And we're very, very, very honored to have both of them with us today. Ojuru, we can't see you, so we'd really like to, put a face to be very certain that we're speaking to Ojuru, who we had in the invite that we sent out. Dr. Ayodeji, thank you for joining us this morning.
Thank you for having me. Good morning, everyone. Good morning.
Good morning. Oh, there you are.
Good morning. Good morning, Dr. Deji, Ayodeji.
Yeah, good morning, Madam Ojuru. Good morning.
Nice to meet both of you and see both of you. We're going to go straight into it. We're going to try to keep to time, so we're going to go straight into it. Like I mentioned earlier, over the past couple of months, we've spoken about raising capital, accessing funding for businesses to help them, scale. And after raising capital, one of the biggest milestones thereafter is, what do you do with that money? How do you go from there, essentially? There's always a lot of talk about raising capital, accessing funding. But do you think that too much emphasis is placed on securing funding and not enough on what comes after? I would ask that question to Dr. Ayodeji. Let's start with you.
Okay, thank you very much. And this is a very topical subject. So I would say to a very large extent, there's been a lot of emphasis that is being placed on capital. And you would see that most times what you always see, the headlines, that what wins the headlines is your ability to be able to raise capital, how the capital has been raised. And there's always less emphasis on how is the capital deployed. So you will look at it, for instance, we saw what happened in 2007, 2008 in the banking sector. We saw how the banks immediately quickly ramped up the recapitalization from 20 to 25 billion. But the capital destroyed that sector. And for a lot, it's just recently that they are resuscitating or getting over that. So currently another set of recapitalization has been done. So I feel that while there's a need to emphasize or the raise capital, there's also need that there should be emphasis on the deployment. So you see that most times there's always lack of clarity, some of the things that should be looked into, even the governance, financial discipline. So I would say that when you're having, rather than just looking at, okay, how much did you raise? So can we begin to look at questions around what problem will the capital solve? What are the major measurable value creation to that company, the institutional capacity that will be built, and the sustainability? That, I think, is really more important than just the focus. Capital, yes, is needed, but most times it's the results of the injection. When you're even doing for the investment bankers, you said pre-money, post-money evaluation. So when you talk about the post-money valuation, beyond adding that, will it be sustainable? And when you also look at what the type of capital, so if I look at, you see that equity capital, sometimes we are concerned around, okay, there will be dilution, but you know, immediately there's dilution in the short term. But if there's the accretion to profit and the company builds capacity in the medium to long term, you'll see that even most of the partial data that you think that has been diluted would eventually improve. So, and that's why it's really very essential that our focus should be beyond just the ability to raise the capital. It should also go into the ability to see what is this capital used for. Sometimes you engage small, the SMEs, most times when you ask them, they are always their number one challenge or concern that they see is capital. I need loan, I need grants, I need financing. But I've come to realize that it's beyond that. It's do you have the setup, are you even ready, capital ready? Because when you inject capital, you expand, and by doing that, you need more controls. Are you ready for those controls? You need more governance. So these are some of the things that I think that we should also be focusing on, beyond just the headlines of the capital raised and the valuation at which the capital has just been raised.
Thank you very much. I think that's why this discussion is very crucial, very important. Ojuru, I would pass this next discussion points to you. You know, a lot of time when we hear that such and such funding, such and such company has received funding, the next thing we also begin to see is a lot of, just spending of money on staff expansion, sometimes even just lifestyle upgrade, to be honest. And all of that. Do you think that a lot of founders are usually ready for the responsibility that comes with the funding that they've received?
Thank you, Demilade, and good morning to the Triad Masterclass community. In terms of the question, specific answer, right? In my experience, what we've seen is that most times these entrepreneurs are not ready. And the reason is, Dr. Abel has highlighted a few things that I think are very critical, and then we sort of have similar points. But project preparation and project development, so it's the foundation as to, you want to raise capital and then deploy. How have you prepared these projects, or how is your company prepared? So there's less emphasis placed on project preparation. And I think that should be at the fore and at the beginning of your, plan to raise capital. Start with project preparation and project development. How are you preparing your project? How is your project going to be structured? Who are the parties you need in the room? You need to put, for most times, from my experience in project finance, you need a number of parties together, right, to deploy any project. So if I want to build a mini grid in a rural community, I need people to come together. I need the EPC contractor, I need the O&M, I need the M&E, right? So there are many stakeholders that need to come into the room in deploying a project. So how am I preparing my projects, right? What corporate structure or corporate governance am I putting in place? Because for you to be capital ready, you need to open up your business to first criticism. You need to open your business to enable more people come in. So if your governance is just centered around you, you take the decision, it's just you don't have policies, it's a problem. So there are critical elements or principles, which is systems, policies, processes, technology. So there's a concept around, processes, systems, and technology, right? And it's really centered, it's taking this center or the attention of the entrepreneur, of the owner, of the founder. You're having policies in place, you're putting processes in place. So for instance, he talked about internal controls. What's the process if you want to draw money from the company? Do you only need the CEO, who is the owner, to approve? Or there are approval limits that empower strategic business units or unit heads to approve, and then they follow a process that everyone can relate with. Because if you want to attract funding, you need to get your business ready. And I dare say that we actually do have capital in the country, in Africa, in Nigeria. Today, asset under management in the pension industry is over 20 trillion naira. So it's not a lack of capital, it's rather a lack of well-prepared projects, quality projects, bankable projects. That's where I see the gaps. And most times, are these businesses structured and ready, to get it? Another thing I have also seen as a constraint too is really around, the equity contribution. So yes, you've gone out to try and raise money from a bank, a financial institution, but do you have your own equity that you're going to contribute? What's your skin in the game? What are you bringing to the table, right? That would give lenders comfort that, oh, this person, I'm sure that this person is there. In some cases, some people may not even have, any form of track record that they've done anything before, to support them, right? But then there may be concerns around, okay, has this business been tested before? As a lender, a commercial bank would not give you long-term money that, they are not sure there's a way out. So most times entrepreneurs complain and say, oh, they need funding, but is your business really ready? The other thing too that I also find is that, how are you going to deploy? So you've raised money today, great. How are you going to deploy? What's your implementation plan? Do you have a project manager on ground that ensures that all the parties that you've lined up together, all the stakeholders, the EPC contractor, the M&E, the O&M, the operations and maintenance. I'm so sorry, I'm using terms. I don't know if you people understand, but yeah. So all the stakeholders that you've put together in your contract to deploy and execute that project, are they organized in a way that enables you execute that project? Have you signed legal agreements with them? Are these legal agreements, do they have liquidated damages that you hold people accountable, and then there are consequences when you don't deliver? So do you have some sort of contingencies that allow you, okay, if you're not executing within the set timeline, you can't go past the window? Because most times, I think in Africa, we've gotten used to the fact that, projects are not executed within the timelines, and then you find situations where there are also cost overruns. That's why you have budgets in place. So it's important that for an entrepreneur who has raised capital or plans to raise capital, you have a bill of quantities, BOQ. You know what you're going to use the funds for, how you're going to deploy. You have a project manager who is there on ground managing that project for you on a daily basis. So your project governance is important. The structure you put together is very critical. So it's not, because a lot of times there's a lot of emphasis on, absence of capital, but that's not it. It's how you're organized. How are you preparing your project? What agreements have you signed? And then I'd say lastly is the human capital. We don't put emphasis on the people, the resources, the staff. But if your project fails, it's not. So there's a project that years ago, I don't know if Dr. Ebel will know about this. Somewhere in the East, they had shipped in some power engines, and they didn't realize that you needed to have specific type of equipment to bring in those power engines from the port to somewhere in Abia State, right? They left those engines there in the port months and months and months. Now, when it was time for them to move the equipment, they moved it to Aba, and they realized that they couldn't fire those engines because of rust. They had rusted at the ports there. So it meant that they had to take it back to America, and they were American engines. So imagine the costs that you've incurred first on demurrage, leaving those equipment there in the port. You hadn't sorted out, your clearing and all of that at the port. Then you incurred demurrage. Then you now took it to the location and is unable to fire because of rust. You have to take it back. All of that extends the timeline and also increases cost. So I would say in summary, it's really having a plan and following the plan to the letter and getting the right people together. Because if you don't have the right people together, I think your project would fail even though you raise capital.
Thank you so much, Ojuru. I didn't expect you to go to say as much as you did, but it really, really went into covering a lot. Essentially saying that beyond getting, before you even, while you're still processing or applying to access capital to get funding, there's a whole lot you need to be doing as, a business owner, setting up your structures, putting your structures in place, corporate governance, your people. I was taking notes, and the entire structure. A lot of things need to be in place while you're waiting to get that funding, and such that once the funding comes, you're responsible enough to make sure that it is, it is utilized judiciously across all of these different would I say aspects of the business. Thank you very much for that. Dr. Ebo, I will be asking you a question that has to do with capital and how it affects growth acceleration. In your own experience and observation, would you say that capital only accelerates a business, or would you say that it exposes the strengths and weaknesses in that business structure?
Okay, thank you. So I would say that capital will only expose what is already existing. So if there are weaknesses there, it would amplify it. If there are strengths, it would complement and improve on it. So when we talk about injecting the capital, so when you see for companies that are ready, that understands why they need the capital. You see, like the example, Madam Ojuru mentioned, the power sector in Aba. You have to do your proper visibility study. So you see, for some businesses, they think that uh, paying for or paying experienced advisors for visibility study, they see it as a waste of funds. But I see it as a cover insurance that you're expecting 1 billion, or let's even take it lower, you're expecting 100 million. You should be comfortable to pay at least 5% of that for different parties to ensure that what's the legal part you need to your market visibility study. You need to look at tighten all boats and knots to ensure that when the capital comes, it actually builds your business and does not break it. Because the way you will run the business when you have little capital, you may even be the one running around combining like 4 or 5 different positions. But when you say you need capital to expand, then it means you need to bring in people. Then you need to begin to assume the strategic role, because so that you don't miss the little things, you need to assume the strategic role and hire experienced hands to take over some roles, and you just complement. So I would say that injection of capital would it can go either way, and depending on how you are prepared. Utilization of funds. So you see, when even businesses come, say, oh, I need to grow my business, I need capital, that's the problem I'm having. The first thing that I would say, even as an investment banker, is that give us the utilization of funds. So it's at that point that they now begin to think through the utilization of fund. And for some, when you see the utilization of fund, you would know that this capital or this person is not prepared to expand this business, because you need to identify the critical areas. And even before you need that capital, sometimes you should or have already seen the gap that, okay, I need to expand to a particular state. You must be able to show that there's demand that you're also seeing from that state, and you can establish it before you just expand. Because what you typically see, you see the expansions that we see for most expansion, and even if you do statistics or research across, most expansion sometimes does not lead to growth. You could be in your little space and be very efficient. So I would also, because I covered the banks for long, then when you look at GTB, in terms of their asset size, in terms of their liability, it's less than even half of some of the top banks. But when you look at efficiency, return on equity, cost to income ratio, they're always the lowest. They're always the highest in terms of ROE, and in terms of cost to income ratio, they're always the lowest in the industry because their own strategy has been very efficient. And you can be engaged in a lot of activities, you can really expand, but may not be turning into good cash flow and profitability. So I think I would summarize this by saying that it's two-edged sword, that capital would first of all amplify what already exists. If it's weakness that already exists and unstructured business, then with that capital, it breaks it. And if you have already built a business with structure from day one, that you have it in mind, even if you don't have the resources, when you find capital, would say that it's like a preparation. You're already prepared for that, and it will help strengthen your business and grow it faster.
Thank you. Before I go back to Ojuru, you mentioned a couple of things that caused me to think, okay, maybe you should speak a little more to help us understand more about value creation. Since a lot of the time, many businesses measure success by revenue or expansion, as you had mentioned, what other factors indicate that a business is really, creating genuine long-term value? Can you go a bit deeper into that?
Okay. I think, yes, that's a very critical question. The first thing you need to look at is your customers. Are they satisfied? And are they returning customers? So if most of the customers you acquire don't do repeat business and cannot refer people to you, it means your cost will be high, because the cost of acquiring a customer is actually very expensive. How that cost reduces over time is based on the repeat business as well as the referral that they make. That is what will bring the average cost of acquisition down. So it's something that for any business you need to watch out for. You need to track. There's what in fintech we say traction. You need to look at that growth in your customer base and don't just be carried away with the customer acquisition. Out of the total customer acquired, how many of those customers are active? They can sign up, but do they order your product? Do they fund the account? Do they save with you? These are some of the things you need to look out for, that your business is growing. Then profitability is key. I will always say that turnover does not automatically translate into profitability. A lot of businesses that when you interact, they can't even tell you what their total cost is, cost of production. So how do you determine the cost of sale? How do you determine your sale if you don't know your cost of sales? So these are some of the critical things that if your profitability too is not growing, even if you start at a loss, for most businesses that have been privileged to run a fintech from start and started from a loss. But what shareholders will be looking at is, after the setup costs, maybe after the first 6 months, is that loss moderating, which I mean reducing, or it continues to amplify? So when you look at your business and you see that you continue to pump in money, capital, whether external or your personal capital into it, and there's no line in sight, that when you look at when you would break even, you need to have that at the back of your mind. When is your break even period? And if it continues to, you shift the goalposts. If it's 6 months, if it's 1 year, and continues to increase to 2 years, 3 years, then you may need to pause and re-strategize. whether it's a business you want to continue, because sometimes in business, you may need to cut your losses and look at other businesses or identify the reason why the business is not profitable. So that's another factor that you need to also look at. Then for you, as you grow, you would see that your corporate governance and control must also be strengthened, because if the rate at which or the way at which you run a business, when the total turnover was 10 million, and it's the same way you're running it when the total turnover is 100 million, it may look like the business is growing, but the crash is always more because there's no control. So as you grow, the controls and the governance that you put in place sometimes will also tell you that you are making progress. Some things you can do that you just from your pocket transfer personal money to do business and stuff, because you have gotten new capital, you now have control. You will have some people ask you questions. Even if you are the owner of the business, is to guide you, is to protect you. And that also shows that you are growing and you are preparing yourself for even bigger capital. Thank you.
Thank you very much, Dr. Ebel. You said quite a few things, and I feel like some of our attendees, people that have joined us over the past couple of months, will probably feel like we keep hammering on corporate governance, control, structure, the right people. But I guess it's because it is what it is, really and truly. These things have to be set up from day one, the right way. Otherwise, when you get to the point where you're either seeking funding or accessing funding, or you've gotten the funding, then it just becomes a monster, or it becomes a big problem that then requires a lot to resolve. Thank you very much for that. I will now take it back to Ojuru, and we'll be talking more about how the business owner relates with the investors. A lot of time, founders view external investors more like just financial partners. In your own experience and observation, I would like to say, how do you think a founder should structure their board and advisory relationships such that they use those investors to add long-term value to their governance and strategic oversight of the business?
Good. So, I mean, you had said earlier after Dr. Abel had spoken about the fact that your community would be, hearing you hammer on structure, governance, corporate structure, corporate governance. I think is really critical for a business to scale. And for you to access capital, and it depends really on the size of capital that you're trying to access, your internal controls, your governance structure is very critical. So from my experience, I don't see financial partners, or I will say external people who provide capital as only financial partners. And the reason is they have experience, yes, not only in providing capital, but then in working with myriad of companies and institutions. There are gaps that one has seen over the years that you can easily plug with, or maybe perhaps an advisor, or maybe a board observer, right? So I like to be very practical. So I know that there was a company that we had from the work I do had finance. It was mainly a family-owned business, and in fact, there are two examples I have to support my point. So it's mainly a family-owned business, and they had come to us to seek capital, and a sizable one at that. And we had told them that, after we've done our due diligence, yes, the project is viable, but your corporate governance, is limiting you from scaling. And because the family-owned business, would advise you to transition, right, from a family-owned business, and will support you through that process. So you get a group of advisors that would come in, look at the structure, enable them to appoint experienced people. So what they will do is identify the gap. So that's the first thing. Identify the gap in the board structure or what you already have on ground. After you've identified the gap, then you now look for the people who are experts. Look for the experts in the field that you're trying to plug. Because if you are a family-owned business and you've been doing business the same way, but now you want to access capital, you want to scale, or you want to even raise a CP in the market. For you to raise a CP in the market, your governance structure should be at a certain level, right? After you have identified the gap, you look for the experts in the room, and then you now say, okay, I want to bring in these people as independent directors, right? Or you may even say, okay, I want to open up my business to attract, funding. So it means you may have to do a public offer, right? And it could be an initial public offer. But then for you to get to that point to scale, that structure must have been entrenched. You must have board committees, and subcommittees. They must have frequent meetings, and then you publish these reports, right? You publish these reports where investors or even, the public gets to see, oh, who are these people? What's their qualification? What have they done before? Because these people that you're bringing on should have a certain level track record is very critical. After you have done all of this, you've identified it, then you actually need to allow them. I listened to my colleague earlier when he was saying that it's your business, yes, but then you invite these people and actually allow them. So in some cases they may criticize you. I know there was a fintech that even the founder had to be sacked. I think it was OpenAI. They had to even let the man go before they brought him back in. So you need to be, it's tough, it's really tough, but you need to be that vulnerable. Another person had come to us in the telco sector, wanted to raise capital, and we had said to him that you have to let go and allow, other people come in. In his past life, that individual had made some mistakes and, had gotten, I would say, public scrutiny, gone to Senate hearing and all of that. And for a financier, you don't want to be involved in anything that has any political undertone, politically exposed persons, or someone who has such record that may be termed as criminal. Your legal due diligence will flag it. So you advise the clients and say, I would advise you to step away from the board and appoint experienced people to, lead. Appoint an observer. Having observers on your board is good. They will observe things and give you feedback and tell you areas that you can amend. Have an independent director. I think that's also very critical. You can also open up your business to certain private individuals who have experience in that field and would add value. We've had cases of prominent Nigerians who have added value. So I think the prominent man who has been speaking on corporate governance in my career has been Atedo Peterside. So that bringing such a person into your board, right, would not only elevate the profile of your board, but will also help you to strengthen governance too. So I won't say you should see external parties who provide you capital as only financial partners. No, they can also be board observers, right? So for transactions that InfoCredit, in the role I play, finances, we go in and we observe. So we sit whilst the board is having, board sessions. We want to really understand the strategic thinking of that. It's part of the DD that we do. Strategic thinking of the board. Is the board, yes, they're qualified people, but are they also capable to tweak their strategy? Are they capable to adjust and amend? And do they have emergent strategic direction, right? Yes, you have a 5-year plan, a 10-year plan, but are you able to always adjust it? No one saw the pandemic was going to happen, right? How emergent is your strategy that it can accommodate, issues like this? So I think the entrepreneur shouldn't see financial fund providers as just financial partners. It goes beyond that. They can act as observers on the board. They can also act as independent directors. They also help you to identify the gaps in the business that they've seen, because most times the due diligence report does identify these gaps. And a financier wants to know, what are these gaps? How can I accommodate these gaps? Or are these gaps too wide and I am unable to accommodate it? Or are there things I can do to support you through that process in your transition? Thank you.
Thank you. So essentially, choose experts and then allow them actually, govern as much as possible. They're not just financial partners. It's great to choose actual experts that fill the gaps in the board and, allow them actually govern. Let go of the reins a bit, right? Don't be too, let's not hold the reins too tightly, because for a lot of business leaders, the businesses are usually seen like almost like their babies. So there's an attachment, emotional attachments to it. And so it's like, oh, these people coming in, changing this or asking me to do this or do that. Really and truly, it's important that we're able to maybe also choose people that you trust to a large extent. So you can't just trust someone's money. You actually have to trust the people as people of integrity, experts that know what they're doing and have the best interest of your business at heart. If you come to me for money, you should be able to also trust that I have the best interest. I have at heart the best interest for your business.
I wanted to add that, there are cultural undertones with Nigerians. It's difficult for us to let go of our business, and that's the very truth, right?
Yeah.
So we really struggle culturally, because you know why? Every Nigerian wants to own something. Every Nigerian wants to be, I'm the CEO, I'm the owner, I'm the one controlling things over there. But for you to scale, you have to take that mindset off, because it's small mindset, right? Most of the companies that are listed on, even Dangote is going, Dangote Refinery wants to be listed. He's done a private placement and raised $2.5 billion, I think. I think the largest in the capital market, exactly. Largest fundraise by any, I think, West Africa, any company in West Africa, I think maybe even Africa, in the private capital space. So if someone of that size, that magnitude is willing to let go, I think it's okay to open up your business, because for every Nigerian, we have this cultural thing that we want to hold it so dear. So I know that there are a lot of emotions around it, but for the scale, except you don't want the business to scale, but if you're expecting it to scale, you need to be willing to open up and listen to the people who tell you the hard truth. Listen to them.
Absolutely. Thank you, Ojuru. To the audience, I would like to encourage you to please ask questions. We don't have to wait toward the end of the session to then, ask questions. Please, if you have questions, feel free to drop it in the chat. We would also be asking for feedback on this session. My colleague would place the link for the feedback form in the chat as well. So you can also give us feedback on what you thought about this session. But please, and very importantly, our questions, any questions you have right now, please begin to place them in the chat. Thank you very much, Ojuru. Now, I want us to focus a bit more on intentional allocation of the funding that has been received or the capital that has been raised. What do you recommend? I'll be passing this question to Dr. But what do you recommend that business owners can do to ensure that the capital they raise moves the business much closer to its long-term vision, rather than simply sorting out day-to-day present-day challenges, I would say? How do you recommend that, that money that is received is really moving the business toward the long-term vision?
Okay. Yeah, very valid question. So I think the first thing is that it starts before raising the capital. So for the funds to be able to impact your long-term strategy rather than solving that short-term problem, you need to first of all ask these few questions. Where are we going? Even as a business, where it's a long-term goal? Why we're planning to solve this short-term problem? Then there's a need to also identify how do you get there. So you want to be the largest supplier of a particular product in Africa. You need to identify what are the things that will prevent you from going there beyond the capital. So the first thing that will come to mind is, okay, I need capital to expand. And also, even when you get this capital, how will this capital remove those constraints? So capital most times should also be divided into clearly defined strategic uses. So you'll see, for instance, when we talk about the utilization of the capital and you are allocating them. So if you know that you want to expand rapidly, then in the utilization of fund, while you are trying to fill a gap or solve a problem, can you also assign capital to technology that would increase and accelerate your growth, which is the long-term growth? Yeah, and that would ensure that you are able to sustain that growth. You may also need to hire key personnel. These are some of the things that will help that long-term goal, because you can't be fully experienced in everything. Yes, you may have an idea based on your experience working across different sectors, but you can't be an expert in everything. So you will need someone to also be able to be in charge and bring in their wealth of experience. It's been proven that sometimes when you inject new people into a company, there are new ideas that spring up, because for most people that have stayed long with you, or you have been working together for long, you may not be privileged to see how things can also be done in another way, which may be limiting your growth. So I would say it's always more about the allocation. So when you look at your customer acquisition, do you have a marketing strategy that would help you acquire these customers, that would you'll be able to, and how do you also retain them? One major area that business, especially even fintech, also fail to focus on is the customer service support. They are too quick to, when you inject that capital, you get the required capital for you to build the platform, expand. You are thinking about expanding alone, but you know that as you expand and you get more people on board on your platform, you will need more customer service support. And if you don't do that, it actually affects your rating, complaints, and retention. And that is really very important. So there's always a need to distinguish between what I would say the growth capital and rescue capital. So once you look at the one that is to settle the obligations and correct some of your mistake, but you also need to look at what will take us from our present situation or present condition to where we think we want to be. That's once you are able to ascertain that and you work towards it, that would also help. One thing that businesses should note, and maybe you would have been hearing it even across, or for me also emphasizing it, is that don't always assume that you know all. Work with experts. It's even if it's for a while, that you, based on the knowledge you garner from them over time, you can sign a short-term contract that for this particular phase, the growth, what we want to achieve, can we work together for these 3 6 months, and you can take it off from there. It helps you sometimes grow faster and avoid try and error, that maybe you have not done something before, but because you may be very passionate about some things, about the idea. Passion is good, or the idea, but knowledge needs to back the passion that you have for that particular business. Then you also need to be flexible. When we talk about strategy planning, there's also what we call about scenario planning, because things move fast, especially in this era of AI and technology. So you must be willing to have scenarios that if this does not work, or if a particular variable changes, how do you quickly adjust your business? Because, like Madam Ojuru was saying, that you see that for when you go and you request for capital, in some of your financial models, they will want to stress test it. What if exchange rate moves to 2,000. Will you be able to survive this business? What of if see energy costs for some businesses, it is the next 6 months that you would see that it can kill a business. It has increased by close to 50%. And if your margin that for you to survive is just 20-30%, and energy cost alone, which let's say is 50% of your production, because across different, it ranges from sectors, some 30, 50, it means that you can actually be running at a loss depending on how huge the business is. So these are some of the things that for most financial advisors and or investment bankers would stress test. And once you're able to also do that, it means you are planning for long term. You are not just looking at the now, and whatever capital you're able to receive, is able to help you solve that long-term problem that would ensure that you are very you are sustainable. The business is sustainable, profit is sustainable, and the growth eventually is also sustainable.
Thank you. Participants, apologies. Thank you, Dr. Ayodeji. Now, I'm going to ask both of you a question for both of you to give us what we would informally call gist, right? So essentially, what I want you to do is, can you give us examples? So the first person I'm asking Ojuru directly first. Thereafter, hopefully Dr. Ebo has a story to share. But Ojuru, I want you to please share an example of a business that gained access to capital or funding and then failed to translate that into long-term value. What do you think? Do you have any in your experience? Do you know of any? Why are you looking that way? Have you?
Because I can't call names.
Of course, don't call any names, but just give us, something. I think to drive home the point that these are real things that happen, where people receive a lot of money, and within 2 years, literally, the whole thing has gone bust. Because, like I said a couple of minutes ago at the start, sometimes I have in my own experience seen where founders literally, it just becomes a lifestyle change, and you're wondering, was the funding given for the business or to help you expand your vehicle garage, or begin to just essentially enjoy your life? What was that funding given for? And like I said, within a year or 2 years, the whole thing has just gone quiet, gone bust. So that's why I said I want you to give us low-key, high-key, some kind of gist as to
Oh my God.
things, maybe an example you've seen in the past where funding was received but it was not translated into long-term value, or mid to long-term value, and what do you think could have been done differently?
Okay, so we're not throwing anyone on that bus here, but I mean, we've seen several instances where I think the business first, or maybe it's the management or the team or the entrepreneur, is not mature enough, to receive the funding that they actually requested to. So in the past, years ago, I don't know, if people can remember, there used to be magazines published, City People, Ovation. So then when I was in the bank, when you have given a customer money, and then you see maybe the customer at a wedding, you see the wedding pictures on Monday, right? In the office, you're just sitting down with your colleagues and you're gisting, and then you see the pictures, you're like, this is my customer, spraying money, and you have not paid the bank. You just see them, at weddings, they're spraying money, and then you get really worried that you start shaking and saying it's like you've done something wrong. And next thing the RM says, oh, let's go and see the customer to know, because people don't have that discipline. And that's where you come to say, separate the business from the person, right? You have to separate the business from the person. It's a legal entity, right? Don't commingle funds for the business and then move it to your own personal account. So in my experience, what we've done to sort of strengthen businesses with that is to have separate accounts. Don't use project money for lao. Don't do that. Let project money be used for projects. So I've seen companies that have been very successful in separating project money from personal money. I think even in the banks, there was a bank who I think was handed over to a son, and I don't know what happened. They kept raising money. Dr. Ebo, you know this bank, I'm just being careful to call their names. They kept raising money in the market every other year. They're raising money in the market, but then you're wondering, what are they using this funding for? Right. Next thing they will say, oh, there's a new strategy. They're going, it's retail. They're doing more retail than ever. And then you're concerned. But now, Access Bank acquired them. And then you're like, okay, so perhaps something was wrong, with how, they raise money. And then you've also seen corporate entities to raise money and not use it for, the reasons that they were also structured. But then I've seen companies raise money and use it properly. I would say today, the Nigerian corporate sector, this is bank and real sector, have learned lessons from past experiences. I want to believe that we've learned lessons from past experiences, right? Where in the past, people raise money and it's not used for what they want it for, right? I think we've learned those lessons, and I want to believe that we're moving forward. So have I seen companies raise money and then I've seen lifestyle changes? Yes, I have. Much earlier in my career, 20 years ago, I've seen people do that, where they are releasing the latest Rolls Royce, or they're going for one politician's daughter's wedding and then they're donating cars. I think it was Rivers State Governor's daughter's wedding many years ago. This was in Rivers State. And, it was during Obasanjo's era. And next thing, they were donating cars. I think on that day, the couple had gotten over 30 vehicles. And I'm like, are they starting a car shop? Are they going to, set up a car business? Or like, this is just confusion for the young couple, But then you see things like that where maybe the individuals who are contributing and who are giving this money either are looking for favors from the state governor or something. So, but I think that project discipline of separating funds for a project for the purpose to which you raise it for should be separate. But then it tells me that most times these businesses were not prepared, were not ready for the funding. So there's this thing we've been saying today on this call about readiness. Are you capital ready? Are you institutionally ready to receive funding? So it's important that as an entrepreneur, you do your own readiness assessment, asking yourself the question, do I have the right structure? So when people raise money, is there an absorptive capacity? Can my business absorb these funds? So yes, I'm running a small business, perhaps the hair business, and I want to scale. I want to open, how do I scale? I think I need capital. Okay, you attract capital, you talk to friends and family, you talk to other people, and then you put a proposal together and say, if I raise this money, this is what this money will do. Be sure that that discipline is there. That money shouldn't go into your account. It should go into a project account. You can call it, for large projects, we call it capital expenditure account, your CAPEX account. So you can set it, separate it, put it in a separate account, and then you don't keep yourself as the sole signatory. You have yourself and perhaps maybe one of your board advisors or someone external, because before the second person signs, because you will quickly sign, but before the second person signs or approves for funds to go out, they would check the bill of quantities, that this is in line with the bill of, they will check the use of proceeds, that yes, this is in line with what you said you would do. They will check the bill of quantities to identify the actual item you're buying. Perhaps are there shelves? Do I need more shelves in my shop, in my firm, in my factory? Do I need maybe a grinder? Do I need a crusher? What equipment am I procuring? Right? They would identify that in the BOQ. Who is this money going to? And then that's the other thing again too. After you separated the funds, the money should go to the person or the right supplier, the right vendor. So if I am into agricultural processing, let's say I process oil palm, and I need to buy grinders, I need to buy crushers, I need to buy pressers, I'm not going to be procuring my equipment. Perhaps the OEM who provides these equipment are not, maybe you have one in Kanu, you have another one in Ogun State. You're not going to be sending the money to Ojuru's account. No, the money should go to, for instance, Benny Agro Enterprises. It should go to this OEM. It should go to maybe, XYZ Oh yeah, so you should go to the specific people that have been identified. That's why your implementation plan is important. Your bill of quantities is a very important when you're doing project. You identify, so the bill of quantities doesn't only identify the items you need, it identifies the OEM, the supplier, the vendor, who is going to supply you this product, the cost of this product, the cost of the item, how many are you buying, those things help you in separating, having, ensuring that the business is not only separate from the person, but also provides you that discipline that you need. I think is very important. But have I specific answer to your question? If I've seen companies examples where companies raise money and are unable to deploy for the purpose at which those monies have been raised? Yes, we've had them. I think there was this oil company. The man's name is in my head. He's a very big man. I think as Arishi Kola. I think that's the name, if I remember very well. And very famous, rich, person. I think even these are companies that have died, by the way. What's his name? I can't remember the man's name, but then I have seen examples where they raise money, buy Rolls Royce, and are unable to deploy, for the purpose at which they've set it up to. So yeah.
Thank you. So essentially, commingling of funds should be a no-no. Proper procurement processes should be put in place. Otherwise, at the end of the day, this funding is going to go to the wrong, it's going to be mismanaged essentially, and we end up with yet another story in the media. Dr. Ayodeji, do you have any stories, any examples to share with us?
Okay, thanks. And I'll just say, please permit me to switch off my video for now.
No
Yeah.
problem. Please go ahead.
Yes. Yeah, so it's more within the fintech space, which area where I think I played without mentioning names. And we've seen a lot of, for most fintechs, what they try to focus on raising capital to build the product. And they don't take into consideration cybersecurity and customer service or selling those products. So we've seen a couple of most of those companies go under quickly. So they expand very fast. They ship out the product, but you would see that they are unable to sustain that business, or one attack alone can wipe off all their capital because they just focus on expansion and they are unable to sustain that. So if I look at some of the if we look at the banking space, that we can also look at some known names, you would see that like the way GT Bank started was not focused on expansion, having branches all around, but the banks quickly began to realize that it's not based on the number of buildings that you have that makes you profitable. They had to do a major analysis, and we saw how they began to shut some branches to reduce their costs, because you say some branches are not profitable. And after a while, or you would hear those days that like churches, you see branches of banks on two same bank on two street, seeing them on one street rather, which you would see that what's the essence of having that. But that's also had to change. Seeing companies, so I can say I know of a company that was just focused. This is more into products within the food space, more into expansion. Let's go to this state. We want to cover 6 or 7 states. They go. But because there was no control, all those capital went down the drain because the branch managers were doing their own thing there and you don't have control. And at the end of the day, what should translate into profitability actually almost costs the entire business, because this is capital that you have to return. It's not a grant that you, even if you lose it, it just affects your reputation and you move on. But those are some of the examples that I think I've seen in my career, that they assessed the capital. They were so excited about that, but actually almost for some they couldn't sustain. They just had to tell customers, come and take your funds out. Or some of them had to sell at a discount to just save their head and move on.
Thank you very much, Dr. Ayodeji. I've just looked at the time, and we're heading towards the end of this session. We have received a question which we'll take in a few minutes, but now I'm just trying to get us to speak about building businesses that last and what that implies for leadership. How do you think the role of a founder or CEO should evolve once external capital, enters the business? What leadership shifts do you think, would be crucial to move the business, over the growth stage where it's at? I would ask this question to Ojuru. If you have something to share, please.
I think it's a great question, and I think this helps to put things in perspective, because yes, all day we've been stressing around governance structure, and how once you've raised capital, what to do with the governance structure. But I think the founder truly, the thought process should evolve truly, right? You've now raised capital, open up your business for people to come in. The role of the founder, yes, I personally, I know that most companies will struggle with, the founder leaving, but I've worked in a firm where the founder eventually stepped away, right, and allowed, individuals, run this business, and the business has been run successfully, still standing today, right? I think, the founder. So I think this happens in the fintech space a lot too, where someone has founded something and then you step away and say, okay, I'm going to do something else. It seems like a pet project for them. So I think the fintech people are able to do that very quickly and easily too. I think today Access Bank too, was founded by a few people. Yes, someone passed on. Ike stepped away, and then he's come back now because of the unfortunate incidents that's happened. But I think in terms of starting up businesses, you should start up a business and have a legacy perspective in your mind. So that mindset shift of having a legacy perspective, that I'm starting this up, I want it to continue to exist until the foreseeable future. So that legacy perspective, that mindset that I'm willing and ready to, ensure I would evolve in the business. I would also say, the founder should, can also get some sort of trainings, right, that would help in, adding more value to the firm. I don't think there's anything wrong with, getting training. I don't think there's anything wrong with upskilling, right? So I think upskilling is also very crucial. And I dare say too, identifying what your customers want, having that at the back of your mind is also very important as a founder, knowing that, okay, yes, this is what we want. We'll continue to serve our customers to the foreseeable future. Identifying the personnel to work with, or people, because it's one thing to start a business, it's another thing to get the right resources or the right human capital to run that business with you or support you on that journey. Identify people who will support you on that journey. I think is also very important. I think I don't want to repeat some of the points that we've said here much earlier, but I think in terms of evolving with the leadership, training is good, spotting strategic ideas, new strategic ideas, so that you're not bored as you're upscaling your structure, upskilling yourself is also very crucial too. Yeah.
Thank you. One thing you said that really stood out to me is the fact that the founder's thought process needs to morph, needs to change more into more of a legacy type of mindset where you know that you've set this up, it is running, it is taking flight, it is growing, and it's okay for me to step away and hand over to, you know, other people that can continue the legacy. Do you have anything to add to that, Dr. Ayodeji? You're speaking, you're muted.
Oh, sorry. Yeah. So I
Okay.
think it's been properly well captured. And what's like we've been emphasizing on is it is well, and what I would say, the way I look at it, that it is better to be part of have a small percentage of a bigger pie than trying to keep a small percentage, keep a total percentage of a small company. So what I mean is that it may make sense for you to have 5% of a 1 billion size company than owning 100% of 200 million company. So, because a lot of Nigerian companies, when my short stay in investment banking, a lot of them want to just retain that their position, retain that their company, which is also what constrain when you say mergers or acquisition, that they want to still be the one leading. But when you bring two companies together, the first question that some of them may be asking is who will lead instead of focusing on the survivor. And I think one quick, also within the microfinance space, there was a transaction that someone was trying to put together, and the founders, knowing that they could not raise capital, they could have sold the license to a new company. But eventually, because of greed trying to sell at a very expensive rate, they eventually lost that license. It means from getting something, eventually you you lost it all, and you also put the little depositors at risk. So these are some of the things for as a founder, you need to know when to say goodbye. They say sometimes you quit when the ovation is loudest, or you also realize that your experience may also not be relevant for the next phase of
Mhm.
that business,
Sure.
which is you need to realize that and admit it. Then you bring in someone that you think can take you to that next phase that you have defined for yourself and provide support. It doesn't mean that you don't you don't have any experience there, but you may not be the core person running that business, and you can complement whatever effort the person is putting in. I
Yeah.
think it's always good to that, because a lot of Nigerian businesses you still see at 65, at 70, they move from being managing director to chairman, executive chairman. They are still involved like executive directors.
Mm.
Yeah, so, and the business may look like it's doing well, but what happens if you are no longer able to do that? What happens? It means that business practically may die. So you need to, any business owner, even if it's a small business and you think you want it to outlive you, you need to begin to think of when to step aside. You look at for Dangote businesses now, I think he is beginning to also realize that key man rates that we always perceive.
Mm.
Dangote Sugar is stepped away from the board. Sure, the Dangote Cement trying to ensure that it's just putting people in place. Yes, you cannot discount his influence, but already putting people in place and the structure will really go a long way to even increase the confidence that potential investors will have in that business, and also help that business to grow bigger.
Thank you very much, Dr. Ayodeji. Sorry, I need to mute the participant. Thank you. Okay. We need to begin to round up, but I want to ask you both to if you could briefly give us answer this question where you have seen businesses that have successfully accessed funding and used that funding to grow their businesses. What do you think they got right? I feel like you've answered this question in different ways, but maybe you would just use this opportunity to kind of reiterate one or two things that you've said before as we begin to look into closing the session. What do you think they've consistently gotten right? The businesses that have successfully received funding and used that funding for growth, what have they consistently gotten right? Ojuru, please.
So I even do have a practical example that I can name, and I'm really proud of them. And I think maybe there may even be many more. So there are several companies, right? They raise funding. So there's this company on Lagos. I don't know if it's called Lagos Shagamu Expressway or Lagos Ibadan Expressway. I'm sorry. I think it's Lagos Ibadan Expressway. On your way to Ogun State, Coleman Technical Industries, right? They raise money from the market. They raise money from, firms that I work with, and I've seen how they've scaled. It was a family-owned business, predominantly family-owned, and they're evolving in their corporate structure, corporate governance. But some of the things that I've seen them do, and then we sort of advise them to do that is first is expanding the structure, your corporate structure, right? Actually having a proper business structure in place. That's number one. Putting the right people in the right, units, people who are experienced. Improving your strategy, getting experts to support you through that journey that you're working through to scale, getting the right people, the right experts, the right consultants in the room, people who have done this before. So it's not just consultants who are just, moving around with their suitcases, but the ones who have actually walked that journey in the past and have either failed or, won. So because, it's one thing for someone to fail. So as a financier in what I do, I'm worried about someone who hasn't failed before. And the reason is, if you've not failed, you don't have lessons to learn, you don't have scars because you won't make mistakes again. But if you have failed, you have your scars, you have learned lessons, and I don't expect you to make the same mistakes again. Documenting the lessons that you have learned. So they've had their, seasons many years ago, but today they now have the first fiber optic factory in Nigeria, in Nigeria, in Arikbo. It never used to exist before. What happened? They got access to capital. Did they learn lessons from the past? Yes. But now they've grown that company 5 times. They come to the CP market and everybody wants to pick up on, the CP. When they want to raise, everybody wants to pick up because you can see how they've used that money, they've expanded. What did they do differently? They improved their governance structure. They got independent directors on the board to support them in the journey. That's independent and experienced directors. So they identified gaps. They identified technical gaps. That identified, I would say, governance and they identified financial gaps. So they got 2 people, one who is an engineer and then another person who I think used to work in KPMG, also a finance person, to support the journey. So they came in, helped in putting structures, helped in supporting. They also got a separate strategy team. And that's because, when a financier is asking questions, is doing their due diligence, they're seeing gaps. Those gaps, you can even take it as advisory. When a company or a financier is doing DD and they identify gaps, you take it that these are the issues or these are the problems actually with your business, and then you solve for it. Because every due diligence report would identify the gaps and then they will even prefer solutions. So you take that as advisory rather than you paying an additional, amount. You take that as advisory. They've told you this is a family-owned business. I need to get independent directors on board. I need to improve my corporate structure. I need to have frequent board meetings. I need to have committee meeting. You put those things, you do those things to ensure that you're actually ready to scale. And then you separate, this is very crucial, separate the accounting. What internal controls do you have? Make sure that the directors are not putting their hands in the business money. The business money is separate from the director's money. The money for the directors is to be decided and allocated accordingly. There has to be policies, there has to be processes, there has to be systems, and you must use technology. You must deploy technology to get your business to scale. Today, businesses who don't have technology are not ready to scale. You can't be doing your accounting in the same old way, bookkeeping, you're recording it in books and all of that. No, there are tools now that are available to you on the internet. Some of them are even free that you can get access to before you get, to scale to get the paid versions. Use those tools that are available to record, your sales. At the end of the day, know how much you're selling. Put yourself on a salary and pay yourself that salary. Don't add any extra, right? Just like everybody in the business, see yourself as an employee CEO. I'm an employee CEO. Yes, I'm the owner, but I'm an employee CEO, and I put myself on the same payroll. Not, when you feel like you take money from the business. No, don't do those kind of things. Once you are able to put this type of systems, processes, structures in place, leveraging technology, I believe that we would see successes in terms of skill. So that's one of the examples that I would really give to people who apply that route, on this part of town would know that business. They've expanded and they continue to expand. Is really around the discipline of how the funds have been utilized, and allocating funds for project remain to be used for the projects.
Thank you so much. Do the right thing the right way from the get-go, essentially. Put the right structures in place, put the right processes in place, put the right people in place, put the right systems in place, from day one as much as possible. It's something, like I said, that we have said in so many different ways over the past couple of months. I would say the past 3 months. We've said this in so many different ways. And I'm really hoping that the business leaders that are, join these sessions, the business owners that join these sessions are taking that away as real learnings to go back to apply, to go back to look objectively at their businesses, because it really just seems like that's the solution to most of the problems that we have. Doing the right thing the right way from the start as much as possible. Thank you very much, Ojuru. Thank you very much, Dr. Ayodeji. We have a question from Christine Emmanuel Oga. Very good point raised. Is there an internal checklist a business should have before trying to raise funds? Can you answer this question, Dr. Ayodeji?
Okay.
Is there an internal checklist a business should have before trying to raise funds?
Yes, definitely. I think I would start and allow Madam Ojuru. I think that's our bread and butter. So the first thing you need to first do is record keeping. It's very important. You need to have your accounts. So as you are preparing to capital, separate, we mentioned one, you have a separate account for business. So when you have that, then you also have records that you're keeping. So that, because when you try and raise capital, they want to see how the business is actually doing. And it's from the bank statement. They will ask you for your bank statement. And they will want to see that the flow. You see, for most of these new banks, likes of Money Point, OP, and that they advance funds to businesses. The algorithm, what it monitors is your sale. They see the way money, the sale is being made, and how you're also repurchasing using that same account. So you need to maintain a business account. You need to also have a strong, depending on your size, a strong board. And sometimes you may not even have those that you need to pay. There's what some even call advisory, that can be one or two, someone that is experienced in that area, or you're also able to afford it. You start with a token for them, and if they believe in that business, they also grow with they grow with you. Then it's also important to also have and train your staff. So you need to also, they want to see what we call segregation of duty. So are you the one that does the procurement? Are you also the one that approves the money? So you will need to have those uh, separate teams for that, even as you grow. Like we mentioned that when you are starting, some of those things may not matter, but as you prepare to go for go for capital, then you need to begin to know that there are some key positions that they will ask you. Do you have an accounts person? Or whether even if it's outsourced, do you have an accountant that you see your management report on a monthly basis? So these are just a few things that I think you need to put in place. But I'll use the floor to Ojuru to do more justice to that.
Thank you, Dr. Ayodeji. Ojuru, please, if you
Thank
have
you,
the
Dr. Abel. So, I mean, you've mentioned, I think, a lot of the points. So, yes, you can have a checklist, and I believe there are resources online that you can, utilize. But most importantly, your legal form, your legal structure, they would ask you around that, are you registered? And they will ask to, so these things you'll be expected to provide, the registration documentation. They would ask you questions around your board structure. It depends on the type of financier you are going to, right? Because I operate on the would I say development finance space, right? So you'll be asked for a lot of these questions. What do you have a board charter? If you have shareholders in the room, do you have shareholders agreement? What is stated in your shareholders agreement? Do you have policies? So do you have policies? What are the processes you have in place? Then tell me about the project you want to raise money for. What's the project about? Do you have an engineering procurement, contract that you signed or agreement? Do you have operations and maintenance agreement? Do you have, if it's large infrastructure projects, mechanical and electrical, agreements to that have also been executed to, these documentations will be asked. So it's sort of like in checklist form, but you're expected to provide it. Have you done ESG, environmental, social, and governance? It's now a big thing, right? Have you taken into consideration social factors in that place? So for instance, if I'm trying to set up a mini grid in my village, right? Have I taken into consideration the environmental factors in that community? Do I have an environmental impact assessment? Do I have any environmental, and social management systems that I intend to implement or I have implemented? Have I done community engagement? So those are some of the social issues. Is the community aware? Is it does the community understand how to use these equipment, or this is a different type of power that they haven't seen before? Do they know what it entails? Your ESG, engagement. Is my project, then you'll be looking at impact. Is my project expected to impact more women? Are there, or female children, people who are considered, vulnerable? What is the impact? So if I'm building a pipeline in a particular community, and I know that I'm going to first dig the ground, I'm going to affect maybe some form of farming. Is it going to go over a water body? And if that community is largely fishery that they sustain themselves on, it means that there's a possibility for some environmental pollution that would impact on their means of survival in that community. There may be no fishes. So there's a particular project that we did. It's so funny, right? And in that community, they're going to do like a logistics zone. So that area had, I think, turtles, but rare breed turtles. And because of the kind of financiers that we have and partners that we have, you're expected to ensure that there's some sort of conservation. So we got technical assistance to support in conserving, turtles in that area. It's funny, but Nigerians, we don't place value on these type of things, but they are important to development partners. They are important to them that ESG is such a big deal, is something at the top that when they are doing their due diligence and you're trying to access funds from impact investors, you must have an impact story that you're telling them, so that's one of the things that I would typically add to checklist. But then imagine that, I'm just going to set up a factory in that location and I'm sand filling, killing all the animals or the water, the, habitats. That's their natural habitat. I'm not doing anything to preserve their lives, those kind of things. Because your concern is about setting up your business. It's not preserving their lives, but having a good balance is very important. So these are some of the things that we typically have in the checklist. So you go around it, then you go around the technical factors. I think I mentioned EPC, O&M, M&E, those type of things. Then you move further to legal, right? You move around to finance. Do you have your financial statements? Who are your auditors? We like to say, oh, we want the big four, but sometimes the big four may be expensive. So you can get to the top 10. There are other audit firms, but then what records are you putting in place, for financiers to come in? Are you separating the business from the owner, the accounting? Do you have accounting systems? And that's why I said there are free resources online that you can utilize to keep your accounting records, right? Then you have maybe some external parties that you have additional information that you perhaps may want to provide about the project, development impact of the project, those kind of things. So yeah, if we start going through the checklist, I don't think we'd finish in time, but that's what it is. Thank you.
Thank you very much, Drew. Thank you very much, Dr. Ayodeji. I hope that, Christine and anyone else who, was who had that question or those concerns on their mind, took note of the lengthy list, because it was quite a lengthy list that was, reeled out. Thank you very much. Before we go, I would leave I'll open it up again for questions. We're waiting to see if there are any questions that anyone has. Please also fill our feedback form to let us know how the session has been for you, so that we know, how we can improve the webinars going forward. Do we have any questions? Just in a few seconds, do we have any questions before we round off? While we're waiting for that, do you have any parting words that you would like to leave this session with, Dr. Ayodeji, Ojuru? Any parting advice for the business leaders on this call?
Okay. Yeah, so I would say that this topic is really very topical, and I think that we can't overemphasize it because a lot of businesses focus more on I need capital, the ability to raise capital, but with less focus on how to sustain the business when the capital actually comes in. How do you add value to the business when the capital comes in? So I would say that we should continue to provide that guidance and the enlightenment around not just the need for capital, but need to have a structure to build a sustainable business.
Thank you. Are you still speaking, Dr. Ayodeji? Okay, thank you. Ojuru, please.
No.
So I think my parting words will be really focused around, preparing your projects, right? Preparing your projects, which I will term project preparation and project development. Preparing your company, getting your structures right and in place. How do you prepare your project? I'll focus my parting words around that. Get your project prepared. Institutional readiness. Is your company ready to receive the capital? You also think around the absorptive capacity of your company. Can you absorb the capital too, right? And then I would say have a mindset, work on your mindset to scale. You want to scale, think about the legacy that you're going to leave. is what I would say. That's my parting words. Thank you.
Thank you so much, Ojuru. Thank you so much, Dr. Ayodeji. Thank you, everyone that has joined us. We're trying to be we're trying to set an example by keeping to time. Today's Saturday, so we're trying to make sure that we just keep to time and we don't take too much of anyone's time. Thank you so much for joining us. We're looking forward to having you again in August when we have our next webinar. Thank you very much. We're definitely sure that we'll be coming with another interesting topic, interesting speakers. Again, thank you so much to our speakers. Thank you to everyone who joined in the audience. Thank you for the question that was asked by Christine. And please feel free to reach out to us if you have any questions. We can always take those questions and provide answers to you later on, maybe via email or our WhatsApp channel. Thank you to everybody again, and please enjoy the rest of your weekend. Bye.
Bye. Thank
Bye.
you. Bye-bye.
Bye-bye, everyone. Bye.
Okay, thank you.